Good afternoon, friends. Welcome to AAA Investor Connect on the special edition on the election day, result day. Today was the very, in fact, eventful day. Everybody was glued to the numbers on the screens, no matter it's on the election results or even on the indices. So, in these challenging times or most eventful, unprecedented events kind of thing happen other than the expectations. Yesterday, we gone through all the exit polls and kind of euphoria built it. And what happened today, there must be much more dilemma in the mind of the investors. And so to give our perspective, the AAA perspective, we are just for the short notice, we arrange this webinar for our esteemed investors. Without wasting much time, I'll invite our managing director and founder, Mr. Rajesh Kothari, to take on this and give us the market outlook perspective, sir, in this time. Thank you. Over to you, Rajesh, sir.
Thank you, Sandeep. Thank you very much. Good evening, friends. As Sandeep has said, it was a hectic day, and I think from last 3 years I've been saying that the only certainty about certainty is uncertainty, correct? And markets have been more and more volatile from last 4 years, and I kept saying that volatility will keep going up; it will not come down. Sometimes you have a US Fed rate, sometimes you have a global election, US election, sometimes you have a state election, sometimes you have a central elections, and so on and so forth. So just thought to quickly give our perspective on how do we see the scenarios which are emerging, number one. Number two, how we are positioned from the portfolio perspective for both our AAA IOP multi-cap PMS, AAA AIF, India Equity Fund, and of course for our AAA Budding Beast mid and small cap PMS. And number three, how do we see the going ahead? Whether we are down underwater as a country, or is there a bright road ahead for all of us for next 3 to 5 years? That's basically probably the flow in which we will talk about it. So first foremost, definitely the numbers what we see on the election outcome is definitely below street estimates. Street was expecting much different number compared to what the actual outcome has been. But that's what the picture is right now, and let's accept it as it is basis. Assuming the good part is that BJP is still the largest party, and NDA is 290 plus. So let's assume that President will invite the largest party of the country to form the government. And considering that BJP is the largest party, we believe there is a hope, it is likely that Modi government to continue. Keeping these two assumptions, BJP forming the government, keeping this as a primary assumption, we believe three important things which one need to keep in mind from the equity market perspective. The first, what will take the backseat? In our view, land reforms, labor reforms, and PSU divestment probably will take the backseat. It will not be the priority, particularly when you have a more like a partnership, coalition, little bit kind of a government. It is difficult to do any bold reforms like land, labor, which may involve society at large. This is backseat. No impact on market, because anyway, market has nothing to do with this by and large. Second important thing is the manufacturing. In our view, the government focus and thrust on manufacturing will continue. Why we think so? Because if you look at this election outcome as well, the one area probably where probably this government has not achieved what they wanted is the jobs. Government has to create more jobs. To provide more employment, there is no other option but to increase the manufacturing activity in this country. The last 4 or 5 years, government wanted to do it, but its hands were tied. Earlier, first the COVID happened, and then Russia-Ukraine war happened. They did their best from the central side by spending more and more, but it takes 2.5 to 3 years by the time the private sector capex starts. And right now we are at a sweet juncture of doing that. So I think that manufacturing activity, the manufacturing thrust will continue. The third very important point is the rural India. The overall consumption expenditure, if you look at it, if you slice and dice in any way, it has impacted significantly in last 4 years. Erratic monsoon, pandemic effect, and many such factors has resulted into subdued consumption expenditure, more particularly on the rural side. I think this government, or probably any government, whosoever forms the government, will take the consumption expenditure also at the top of its priority. These are the three important points. When somebody wants to do spend on the rural side, the natural question which comes to investors' mind, what will happen to our fiscal deficit? Because if you spend excess, then fiscal deficit can become a challenge. The good part is India is right now in a very strong wicket. We have a fiscal deficit is within the control. On top of it, RBI has given extra additional 1 lakh crores. It means that even if at the risk of 0.3, 0.4, 0.5 fiscal deficit, even if it 0.3% higher, 0.4% higher, by and large, it will not be a major issue. So fiscal deficit by and large will not be an issue. Generally, fiscal deficit is very important, particularly from the foreign investors' perspective. But because we have a cushion effect, I think fiscal deficit will not be a major challenge for the government. So these are the 4 things from the market perspective, what is important, what we need to focus on. Coming to our portfolios, across the portfolios, we have been highlighting in our March webinar, and we have been already also highlighting in January conference calls, that there are many pockets of markets where there is an exuberance. Throw the dart and make the money generally never lasts long. But last 9, 10, 12, 15 months, there are many companies, particularly on the micro cap side, which went up significantly. Many of these stocks doubled 3 times, 4 times, 5 times. Their balance sheets, they were not that strong. They are not supported by strong fundamentals, but stocks went up. There are many companies, even within the PSU basket, many of these companies also went up double, triple, 3 times, 4 times, 5 times. In fact, many companies went up 75% up in last 2 months. Such trends are never sustainable. Only if the company has a strong fundamentals, strong balance sheet, and strong earnings growth, it can justify the good premium valuations. But if these 3 things are missing, then only the low floating stock cannot be the reason for stocks to keep doing 10% up on daily basis. But we have seen it has happened in many companies. And at that point of time also we said, this is a risk. So there are pockets of market where there was excess valuations. There are pockets of markets, there is exuberance. There are pockets of markets where poor quality stocks went up significantly. Let me tell you, we have zero exposure to one large corporate group. I'm sure we all know what I'm talking. Gujarat-based group, we have a zero exposure to that group. We have a zero exposure to pure oil and gas companies. We have a zero exposure to metals. We have a zero exposure to railways. We have a zero exposure to large NBFCs which are doing business into the power. We have a zero exposure to all these companies, not today, from last so many years, including last 12 and 18 months. And therefore, the change in equation right now, what we are seeing on the election front, which can have a significant impact on this kind of stocks, we are insulated because we do not have any exposure to that. In terms of our current portfolio structure, let me share with you how we are positioned currently for both our portfolios, AAA IOP as well as AAA budding based. Please give me one moment as I share this screen with you. This is our AAA IOP. As you all are aware, AAA IOP is a multi-cap portfolio. It's a 50 stocks diversified portfolio. We have been always proponent and probably we are pioneer of 50 stocks in the portfolio. And we know that every year some exceptional things will happen either at macro level or at micro level, either globally or locally. 50 stocks portfolio helps you to absorb such risk. Many times investors have asked us, why not we do 5 stocks portfolio? Why not we do 9 stocks portfolio? And we always tell investors that as a fund manager, I can't predict Russia-Ukraine war. I can't predict US Fed policy. I can't predict US interest rates. I can't predict how many seats Modi ji will win. So what is in my control is only the companies which I buy, but they also get impacted by the macro factors. But when you have a 50 stocks portfolio, 50, your ability to absorb such shocks goes up significantly. So AAA IOP is a multi-cap PMS, 50 stocks portfolio, and here is a sectoral allocation. Banking and finance is 27% of the portfolio. We are slightly underweight in banking and finance. Within banking and finance, our PSU banks exposure is roughly about 3 to 4%. We own State Bank of India, and we own Bank of Baroda, and we own Indian Bank. 3 banks combined is roughly 3 to 4% total portfolio of PSU banking within banking. I don't think PSU banks will be impacted significantly. These all are pretty large banks. They are growing banks. At the same time, their valuations are also equally comforting. Their credit cost is also improved a lot in last 2, 3, 4, 5 years. And their ROE has also improved equivalent to just like any other private sector banks. So this is overall banking and finance. By and large, we believe that economy will continue to do well. Our earnings growth of the economy will also continue to do well. So I'll come to the market outlook secondary, but first I'm talking about how we are positioned. So that is about banking and finance. Here we own the large private sector banks. ICICI Bank is our top holding, followed by HDFC Bank, Cholamandalam Finance, Bajaj Finance, Shriram Finance, largest gold finance, which is Muthoot Finance, and as I said, 3 to 4%, which includes SBI and Bank of Baroda. Then we have automobile and auto ancillaries, 14% of the portfolio. There is nothing to do with this by and large about the government or election. This is the basket which will do extremely well. In fact, if the government puts thrust on the rural economy, then we own two-wheeler companies like Hero Motors and TVS. We have a zero exposure to commercial vehicle. We have a zero exposure to passenger vehicle. Our exposure is to two-wheelers and tractors and auto ancillaries. We are very positive on these names. We are very positive on this thesis. As more and more regulations comes into the sector, auto ancillaries will be the biggest beneficiaries of those trends. The electrification of the vehicle is going to be the biggest theme for next 5 to 10 years. And all of our portfolio companies are rightly positioned to capitalize on that opportunity. Say, for example, earlier there used to be 2 airbags. Now we have 4 airbags. And from 4, it has become 6 airbags. And from 6, it has become 8 airbags. Who will be the biggest beneficiary of this? The companies which supply airbags. One of our auto ancillary company, which is Uno Minda, earlier the Minda industry, is the biggest beneficiary of these trends. And likewise, every auto ancillary company in our portfolio, they are benefiting from more sensors, more cameras, more wiring harness, more cables, more airbags. They are the biggest beneficiary of that. Software is one sector which we have increased in last 2.5, 3 months. Earlier, we reduced our weightage during Russia-Ukraine war. From 14%, we reduced the weightage to 7%. Currently, we are holding 9%. Again, it has nothing to do with the election. I'm just trying to give you how much percent of our portfolio is not significantly impacted by the changes in, if there are some changes in the policy here and there. Consumer is one sector which we always used to like, and in fact, we have a little bit added the weightage to the consumer sector in last recent months. Again, here we own both discretionary as well as FMCG. We added FMCG sector, particularly in very recent times. Earlier, we used to have only consumer discretionary. Our largest holding is Trent. Our second largest holding is Titan. And of course, we also own few other companies within consumer bucket. Again, government thrust on rural recovery, little bit on consumption expenditure. If there is any such change, will again benefit our consumer sector. Fourth is engineering. This is a very interesting space. From last 4 years, we are probably one of the early one to identify capital goods as a theme. We said CapEx story will do extremely well over next 5 to 10 years. And our thesis went right. But we do not own any companies in this space which are directly infrastructure. Like, for example, road company. We have a zero exposure to road company. We have a zero exposure to construction company. We have a zero exposure to pure power producer company. What we own is the portfolio of the companies where product portfolio is important, where technology is important, where research and development is important. These companies are debt-free, and they are the biggest beneficiary of the not only government policy, but also changing consumer behavior. What I mean by this, I'm sure you all are aware, we all need our mobile connected 24/7. If you want mobile to remain connected 24/7, if you want data center to be connected 24/7, if you want more and more power without much volatility, without power fluctuation, you want consistent power supply to your plant, what you require is a smart grid. What you require is power automation solutions. If you require more metro trains, what you require is a SCADA systems. Our largest holding is Hitachi Energy. Our second largest holding is KSB Pump, which is the third largest pump manufacturing company from Germany. The third largest holding is Kirloskar Pneumatic, which is the largest company in compressor, and so on. So we do not own any direct infrastructure play. We do not own any railway. We do not own any wind EPC related companies. All our portfolio companies are extremely solid businesses. And here also, our weightages was earlier 14-15%. Currently, we own about 10% in our portfolio. Pharmaceutical is one space. Many of the participants, they are my existing investors for so long time. Just to recollect, we used to have zero pharma. On 6th March 2020, we increased pharma from 0% to almost 9, 11, 12%. Pharma stocks went up by 65% in 4 months. We exited entire pharma and made it zero. And after almost 2.5, 3 years, from last 4 months, we are becoming positive on pharma, and we are adding to that basket. Currently, we are holding 7% pharmaceuticals. Telecom is 5%. Again, I think it has nothing to do with the elections in the government. We all will be using our mobiles, so you require telecom. So it's more like a defensive bet. And we have increased our cash levels to about 8%, and we are sitting on 8% cash. Oil and gas is primarily Reliance, what we own, about 3% of the portfolio. And there are others like textile companies, what we own. So this is overall IOP sectoral portfolio. Primarily, large part of the portfolio, significantly large part of the portfolio is what I would say beneficiary of if government makes any changes in policy like rural consumption, or they are insulated from changes in government, be it IT, be it telecom, be it consumer, or be it a specialty chemical because they are exports driven, or be it also to certain extent banking and finance. So that is about our IOP sectoral allocation. One important slide which I always show to all my investors, how our portfolio characteristics are. As I said, IOP is a multi-cap, 50% large cap, 55% currently is large cap, and balance is mid and small cap. All companies are large by profit size. They all are, most of them are debt free, and they have very solid high earnings growth. Coming to Budding Beast, in terms of the sectoral allocation, this is how the Budding Beast looks like. Again, here 14% is consumer. We own primarily discretionary consumer. Automobile is roughly 10%, including auto ancillary. Pharma, we are adding to the weightage, so about 9%. Here we own very low banking, about 9%. Engineering is 22%. Most of these companies in engineering, as I said, they all are heavy product companies. They are biggest beneficiary of the smart grid, automatic solutions, process efficiency, HVDC project beneficiary. Chemicals we have added recently. We used to own large chemical. We made 0 2 years back, and now we are again holding 4%. So this is how our Budding Beast portfolio is positioned for. In terms of the characteristics, again, this portfolio, all are market leaders. Most of them are under leverage. They have a large profit size, and they have very strong earnings growth at the portfolio level. This is in terms of my Budding Beast portfolio. Coming to the market outlook, I strongly believe that market is mirror of earnings growth. This is not the first time that we are seeing correction. Corrections are part of market. Let me show you one important slide. If you look at this, there is not a single bull market which went without correction. And sometimes corrections are sharp. If you look at 2002 to 2006, when Sensex became 5 times in 5 years, there were 6 times market went down significantly. Sensex went down 15, 18, 20, 25%. But because the earnings growth was so strong, market kept delivering. And I think this time is not going to be different. Be it a COVID times when market sees significant correction, or be it a Russia-Ukraine war time, market witnessed significant correction. But any investor who took that as an opportunity, keep faith on equity as an asset class, and make sure that portfolio has a very good earnings growth, those kind of portfolios has always delivered in the medium to long term. Yes, there is some uncertainty on political front. Yes, there will be higher volatility in the equity market. Yes, there might be some short-term correction because of this uncertainty. But if you are a medium to long-term investors with a 3 to 5 years time horizon, these are the times which you should not miss, because whenever you use such opportunity, you get extra returns in the longer time frame. If you look at this slide very carefully, look at here, FY 2008 to FY 2023, our earnings growth is only 9%. But as earnings growth keeps going FY 24, we have already delivered 18% earnings growth. See, the earnings growth keeps moving up 14%, 15%, 16%. And India has all the right building blocks for the better earnings. Then market will eventually deliver in line with the earnings growth. On the valuation front, after today's correction, the valuations are now actually come down, and we are below 10 years average price to earning multiple. So even on valuation front, we are attractive today compared to what it used to be, compared to yesterday, what it used to be. So, our GDP growth is one of the fastest. Our earnings growth is very strong. Our corporate balance sheet is improving. ROE of corporate India is also improving. Good earnings growth, good balance sheet, good ROE, and attractive valuation. These are the 4 things which are in our favor. What more you can ask for? Political clarity will emerge in few weeks, but the investors would take such opportunities, such corrections as an opportunity. They tend to benefit in the medium to long term. So that's basically our view on the market. We are reasonably positive in the market with medium to long term. And we advise our investors that maybe they can do 40-50% investment they can do today, because market has given a good opportunity, good correction of 7 to 8%. And the balance, maybe one can spread it out over 2 to 3 months, so that whenever you get more visibility, you can use that as an opportunity. Let me also tell you, going by the investors' behavior, going by the a lot of noise what media will create, channels, newspapers, there'll be a lot of noise for next 20 days. But remember, during COVID time, there was a worst time, worst of the noise. Everybody, in fact, our dear friends, our relatives, our neighbors, they were in hospitals. And there are so many investors, they got worried. But the investors who didn't got worried, and the investor who took that opportunity, that time, to have a faith on equity as an asset class and add to it, those investors made significantly high returns. They even never thought that on 20th March 2020, if you invest your money, it will probably double in 3 years. They never thought so, but they made that kind of a money. So the limited point what I'm trying to convey you is that I'm sure you would have seen at least last 4 or 5 years of volatility. And the one lesson to learn from that volatility is take it to your advantage. Use it as an opportunity. Take it to your, don't be slave of noise. That's something very, very, because we all get influenced as human beings, we get influenced, but that's a time when you need to sit back, you need to relax, and you need to think what India will do over 4 to 5 years. If you are going to become the third fastest growing economy, then probably our market cap to GDP, our valuations, our earnings growth will be much higher than where are we today. Keeping in mind that, I think long term we are extremely remain positive on India as an economy and India as a story, notwithstanding the short term volatility. With that, I think we should open up for question and answer, because I'm sure many guys would like to interact rather than one-way dialogue. Anyway, it was a very brief call. We just thought to engage with you to answer any of your queries. Thank you everyone for your valuable time, and please feel free if you have any queries.
Participant, please post your questions in the Q&A section. There's one question from Mr. It's one anonymous attendee. It's I believe that's rather than market, it's a political question. Suggest you please talk more about possible outcome, basis possible mandate and way ahead. And if the incumbents can still hold things together for 5-year term ahead.
Just a minute. Sorry, I didn't get the question. I'm not able to see the question on chat box. Sandeep, can you repeat?
Please suggest or talk more about possible outcome, basis possible mandate and way ahead, if the incumbents can still hold things together for 5-year terms.
Okay, super.
Structure-minded question.
Good, great. So basically, I think as I said in my opening remark, I believe, BJP being the largest party will be invited, am I right, to form the government. And if you go by the numbers, then I think they should be able to, as I'm saying, likely, hopefully, they should form the government. And yes, there'll be more Gathbandhan, of 1 or 2 parties, particularly, which everybody is talking about, JD and TDP. Their support will be, of course, very, very crucial and critical, and they will be able to take them through. I think, if you look at the UPA government, for 10 years, they have done a coalition government, correct? I think, NDA will also learn how to run the coalition government. But the biggest difference compared to what was India coalition 10 years, 20 years back compared to today is the number of seats of BJP. So it's not that BJP has got 100 seats, right? The number of seats are very high. So I think there is a reasonable possibility and high chances and high probability that they will not only form the government, but will be able to walk through and complete the 5 years successfully. Also keep in mind that when you have such kind of a coalition, the few things which you probably government will avoid doing it. Like, for example, agriculture reforms. I think it's a very sensitive issue. They have already tested once, farmers protest were, and then they withdrew from it. So I think they will not touch farm related reforms, because this is more political sensitive thing, correct? They will probably not touch PSU divestment, because again, union, labor, they will not touch that. They will not touch the land related major reforms. Again, it can become political sensitive. So any area which is super political sensitive, I think they will avoid doing it. But other areas which are not political sensitive, digitalization of the economy, formalization of the economy, the tax compliance, GST implementation, all that stuff are success stories. And one thing which we have learned in last 40 years of India political history, reforms are irreversible, and it is very easy to talk guarantees and freebies. But when you come to power, everybody knows it is not easy to implement. We already seen Karnataka what is happening, am I right? So talking is one thing, and implementing to its core is something complete, and everybody knows about it, and the opposition also knows about it. So I think we will, in my view, hopefully, likely, BJP will form the government, and they will learn how to run the coalition, and they will successfully complete 5 years without much compromise. As far as our market goes, there might be many things which they might have in their wish list, and they may not be able to do it. It is more to do with the general social fabric. I'm not here to talk about it, but keeping in mind our markets, economy, what matters to us, I think we have nothing much to worry about. But at the same time, as I said, there is exuberance in few pockets. Am I right? Like there was a terminology called Modi stocks. Now, those things, anyway, we don't have exposure that the level of Modi stocks. Like, for example, railway stocks, they went up like balloon, as if, they become the great multinational companies. Definitely growth was not so high. We were also surprised why they were going up. There are many power utility companies, particularly small power, NHPC, SJVN. I mean, there was no change in these companies. Let me tell you frankly, there was no change. But stock price become 4 times, 5 times. I hope they change themselves. I mean, I don't have any issue, but at least we could not digest that. So we have zero exposure to that. Yeah, there were some stories where it was just narratives. Just because it was PSU stock doubled and tripled and 4 times. Definitely, underlying fundamentals were not supporting. So I think you need to differentiate between man and boys. You need to, and that kind of will basically make you portfolio very, very disciplined, quality portfolio. I'm keeping myself limited to markets and economy, what matters to us the most, rather than going into the general politics.
Thanks, Rajesh. The another question from Mr. Shri Balaji Sampath. What structural changes do you think Modi 3 government may bring in your opinion? I believe that the same you answered earlier.
No, let me add to that. Good question again. I have read the BJP manifesto, and I'm sure you would also got. Everybody must read that BJP manifesto. It is a more of the same. It is not something new. Correct? They have to accelerate their existing reforms, what they have done in Modi 2.0. They will further accelerate to the new level. Every time you don't need structural reforms. Correct? Every time you don't need, they have not talked about land reforms, labor reforms in their manifesto. But if one is assuming that they are not going to do it, those are structural. PSU divestment, structural. I don't think it will happen. Correct? And they have not talked about it in their manifesto. They have talked about in manifesto the things which is related to the society, making them better, making, reducing poverty, digitalization, no gaps, no corruption. It is a more of the same, but it's a good thing. That's what we need. We need consistency of the policies. We need continuity of the policies. We need more thrust on execution of the policies. And more importantly, we need efficiency in policy execution. That's what this government is known for in last 4 years particularly. So if you remove the demonetization and the GST, these two are the major reforms. There are many other things they've done, but two major reforms is the demonetization and GST. Everything else is a change in the way in which government used to work. Like, for example, a telecom policy, making it transparent. It is a process, correct? Or giving it auction. It is a process. Building blocks or mining. They've changed the way in which mining blocks get used to given earlier on allotment. They've changed it. It is a process. Am I right? So there are a lot of process improvement they have done to make sure that government make higher revenue. At the same time, there are no leakages and there is no corruption. And finally, the end user get the biggest benefit. Am I right? And I think that trend will continue. Not only continue, it will further accelerate, in my view, over next 5 years. I don't see any change in that.
Okay, thanks, Rajesh. One question is, what is the PSU exposure for AAA PMS strategies?
A good question. I think 1 month back, everybody was saying, I hope you have a good exposure. And now people are asking, what is your exposure? So, good question. When we build the portfolio, we never discriminate between PSU and private. For us, if a company is good, if the business model is good, if the growth is good, if the balance sheet is good, if the valuations are good, we buy that company in our portfolio. In our AAA budding beast, our PSU exposure is probably less than 5% or so. In our IOP, our PSU exposure is probably also about 5 to 6%. So very, very low PSU exposure. In our IOP, what we own in PSUs, we own State Bank of India, Bank of Baroda, and Indian Bank. These three banks combined is just 4% of our portfolio. What more we hold in IOP in PSU? We own 2% Bharat Heavy, BHEL. So that is our total PSU exposure as far as IOP goes. We used to own Hindustan Aeronautics, Defense in our IOP. We have exited Hindustan Aeronautics in the portfolio. In our AAA budding beast, our exposure is very, very limited. In banking, we own 1.5% Indian Bank. Then we had Cochin Shipyard, which used to be 2.5%. We exited Cochin Shipyard completely. Company is very good, no problem on the company, but the valuations were very rich. And we said probably this valuation they may not sustain. So we have exited Cochin Shipyard completely. And another company what we own is Bharat Dynamics, about 2%. So only 3% exposure probably in budding beast and about 4%, 5% exposure in our IOP. So very, very low exposure to PSU stocks in particular.
Thanks, Rajesh. Next question. If someone wants to do STP right now, what should be the right time frame to do the STP?
Well, I think, timing the market is extremely difficult, particularly in such times. But generally, whenever markets are down 7-10% kind of thing, it's a good time to start investing. One may invest today 40%, 50%. Balance you can stagger over a 2 months, 3 months. So as you get more political certainty, if the market corrects more, in case you can prepone your STP. So maybe you can do part right now and part you can do spread over 2 to 3 months. I think that will be the best scenario for STP perspective.
Okay. Thanks. Which are the pockets where you see the major decline in the going ahead?
You mean where we see the maximum pain because of
maximum
disappointment on the changes? Okay, got it. I think the maximum pain will be one pockets which broadly the companies which are poor quality. Please understand, last 18 months, it was throw the dart, make the money. I said in my opening remark. Be it a PSU or be it a private, there are many companies without strong fundamentals, stocks went up through the roof. If the company doesn't have solid fundamentals, please differentiate between luck and skill. Even to us, when we evaluate our performance, we differentiate between luck and skill. Is the stock went up because of your luck or stock went up because of your skills? Please make this differentiation, right? So any companies where the fundamentals are very weak, but the stock price is doubled or tripled, those are at risk, number one. Number two, there are many companies, particularly on the micro cap side, the SME side, they went up like 10x in last 2 years. Those things definitely will come down to where it should be. And third pocket is to certain extent PSU. I will not club every PSU as a in that basket, but there are many companies within PSUs where the stock price have bubbled, and probably the valuations are extremely high. Not that all companies are not good. There might be many good companies even within that basket, but the valuations, keeping in mind the growth and keeping in mind the balance sheet and keeping in mind the policy risk, probably the valuations have crossed, even many companies have crossed FMCG companies valuation. And those are the dangerous time, those are the not sustainable time, and those are the pain points, if you ask my personal view. Of course, there are some industrialized group which also might be a little bit under pain point because of course, the valuations also may correct there. Thankfully, we have a zero exposure to such pockets where the pain can be very high.
Okay, great. Thanks. The next question from Mr. Neeraj Thakkar. Please throw some lights on right now, if a new investor want to invest, how should he position himself? During about our schemes, I hope that question is regarding.
Okay. Thank you, Neeraj Bhai. I think, as I said, if one wants to invest, time in the market is more important than timing the market. Don't wait too long. Market is corrected. There is a earnings growth. This is the fourth consecutive year. Nifty has delivered 18% earnings growth. Double-digit earnings growth. It happened in 2002 to 2006. And in that time, Sensex became 5 times in 5 years. Don't forget it. We are seeing mini trailer of corporate earnings growth, fourth year of 18% plus earnings growth. I think earnings growth looks very, very strong in my view. The macro of India is we are in a best position, be it a fiscal deficit, be it a current account deficit. World is having many problems. Europe and China are facing major issues. We have got opportunity to improve our exports. So I think there are so many pockets where the growth is going to improve. Please also keep in mind that the banks have improved their balance sheet significantly. Our credit cost is one of the decades low, 10 years low, our credit cost. So from that perspective, I think earnings growth can do reasonably well, keeping in mind 2, 3, 4 years. At what valuations you are buying that growth? Below 10 years average price to earning multiple. Our 10 years average is 20. Right now we are at 19 times. So 5% discount compared to 10 years average price to earning multiple. So when your growth is good, balance sheet is good, and valuations are also attractive, that the 3 dots which you need to plot on. And if that is in your favor, generally speaking, with a medium to long term mindset, it will make you reasonably good returns in the long term. So I think one should not wait too long. As I said, maybe 40 to 50% one can deploy today, considering the market is already corrected, and maybe a little bit more tomorrow, and then spread it over 2 to 3 months. And as soon as you get some more political certainty, that time you can invest the balance.
Okay, thanks. Next question is from Mr. Hemang Ajmera. How does the distribution percentage determine? Will election outcome have any impact on distribution? In fact, he was talking about distribution of percentage allocation in different sectors.
Yes, good question. Yes, I think everybody is having on the top of the mind this point that how this thing will work. That's why I said that the rural India is under pain, and government probably keeping in mind the outcome, they may increase the allocation to rural India. It means a little bit more expenditure. And if they do that, then rural India will do better. And if that happens, then the consumer stocks will improve. If you look at our portfolio in both AAA IOP as well as AAA budding based, we are 12 to 14% exposure to consumer sectors. On top of it, we also have exposure to two-wheelers. Two-wheelers are the biggest beneficiary of rural recovery. And of course, the auto ancillary. So combined, if you look at it, we have an auto and auto ancillary about 10% in IOP and 14% is consumer, 13%. So 25% is actually rural link, and same is for budding based, 25% is rural link. So that may happen. The good part is that our balance sheet right now at the country level is very strong. So we can afford to spend on rural India on the consumption side. So that's the one sector which I think you might see some changes in terms of the spending. Otherwise, on the overall infrastructure side, I don't see any major changes. I think infrastructure spend government will continue the infrastructure spend because power is like roti, kapda, makan, and power. Power is also your requirement. To commute is your basic necessity, am I right? No government can switch off power and spend on to farmers. You can't afford to do that. Or no government can switch off railways that I will not spend because we are already underinvested in railways. And the good part is that BJP is already having so many seats. So I think the power as well as railways kind of thing the overall government side infrastructure, they will continue to do well. But of course, within that, you need to have the right companies, which can benefit out of it. So we do not have any exposure to power utilities or for that matter, also any railway finance companies or any company directly linked to railway. We do not have such exposure. But otherwise, I'm saying from the spending perspective, I do not see any significant cut on those because we have a good balance sheet. RBI has given 1 lakh crore special dividend. So I think there are enough cushions from that perspective.
Okay. Thanks, Rajesh. Next question from Mr. Sri Balaji Sampath. Will FDI inflow increase in the likelihood of NDA forming the government? Will the markets run off if the FDI inflow increases?
You mean FII or FDI?
They mentioned FDI. In fact, I hope that he must
Okay.
have expected FII rather than FDI.
Okay, let me put on both. So as far as FDI, foreign direct investment goes, I think I don't see any negative impact for FDI because the options are very, very limited. And please keep in mind that, whosoever forms the government, they have enough number of seats, right? So, there is no option, where they will invest, correct? Europe is not investing into many sectors. US is also not. China, you have to diversify supply chain. So India will remain a good choice as far as FDI goes. As far as FII goes, I think they'll wait for political certainty. They are anyway net sellers in last few months, and I think they may do wait and watch. If the valuation turn attractive, definitely they'll become a buyers. Let me also share with you just one tweeter by Jairam Ramesh. In fact, he just tweeted sometime back, maybe a few hours back, that there is no reason for market to panic. We will announce our agenda, economy friendly agenda very soon. So, I mean, what I'm trying to say is that every government, every party knows there is no substitute for Vikas. Development is important. If you don't do any development, then nobody's going to vote for you. The necessity is India is no more poor, hungry country. No. Our basic necessities have changed. From roti, kapda, makan, we have now evolved. Every household has two-wheeler, every individual has a mobile. Correct? So our requirements, our aspirations are different. And any party, whosoever party it is, they will basically have to do the development on the growth side of the state or even for that matter for the center. So I don't see any significant change in the priorities for any government. Please don't go by the media statement. The headlines might be different, correct? The actual implementation can be completely different than the headlines. So headlines ke liye somebody may say that I will give you this free and that free, but everybody knows that that is not going to work out. So, we need to, I think for next 20 days or so, as I was talking earlier, if you switch off media, probably you will make more money rather than, every headline otherwise will probably confuse and lead to more volatility.
Yeah. Thanks, Rajesh. Next question is from Saparna. Your view on GDP to market cap ratio?
Good. The market cap to GDP. Okay, let me directly share with you one very important slide, in fact, which we prepared. Give me 1 minute and I will share with you. Okay, here it goes. So this is 2010. India was 9th largest at 1.7 trillion. This is 23. India became 5th largest, 3.9 trillion. And this is 2030, where we are likely to be the 3rd largest. I repeat, from number 9 to number 5. What happened to market cap to GDP? We were 97% and then 108%. That's it. But actually, you think through it, where US moved, US remained number 1, but their market cap to GDP went up from 100 to 186%. So what we did is that we did some scenario analysis. So if you look at our market cap to GDP, which is 97% in 2010, and let's assume 97 remains 97, still there is no downside, correct? Because in that case also, in fact, if you look at the average, 13-year average, it is 82%. Even if you assume 82%, there is no downside. In fact, market will still give you more than fixed deposit returns, post-tax basis. If you assume current market cap to GDP to continue, then market will give you 11 to 12% compounding returns. But importantly, if you look at last 13 years, average of US, the market cap to GDP was 151. Right now it is 190, but 13-year average is 151. You put 151, then market can give you 17% compounding returns over 5 years. I'm talking about all 5 years. So market cap to GDP, right now, say 108%, significant, what I would say, potential to improve this number. Even if it remains 108, you will get 12% compounding returns at current market, despite we becoming third largest market cap. Even if you assume same, we get 12% compounding returns.
Thanks, Rajesh. The next question, again, we'll leave the same question. What sectors are expected to benefit or suffer from the election outcome? I believe we already answered, I think.
I think we already answered sectors to suffer. There are no sector as such, is more company specific. And of course, there are, some baskets within PSU where there can be more pain point. I think we already talked about.
Yeah. The next question is this. Your view on HUL versus ITC. I think this is not the right forum to talk about individual stocks.
It's okay, but we have zero exposure to ITC. We have at different points of time in last 15 years, we have exposure to Hindustan Unilever. We monitor the business cycle very closely. Last we bought was on 10th during COVID, before lockdown, or during lockdown we bought Hindustan Unilever. We made good returns out of it. We exited completely. Probably in 6 months time we made good returns. We are reevaluating it, and it will become maybe part of the portfolio whenever we think it is right. We do not own any ITC, and currently we do not have any positive view on the same.
Thanks, Rajesh. What will be the scenario, or the next question is, what will be the scenario in government institutional stocks in next 3 to 5 years? I don't know.
Government institutional stocks. Sorry, I'm not able to get this question.
Yeah, actually the question is incomplete, I think.
Maybe
we have covered this answer. It is all institutional stocks, maybe PFCs, RECs, and many. So these are the institutions,
PSUs.
Mainly PSUs. So we have already answered this.
Yeah. The next question is, will retail investors participate more in the equity market in the next 5 years?
Well, equity market always gives you strong returns in the long term. Volatility is part of market. I'm sure everybody would have seen volatility last 3 years, COVID times, Russia-Ukraine war times, many times. But if you keep faith, this is the asset class which gives you always reasonably strong returns compared to any other asset class. Today in fixed deposit, what is the post-tax returns? 5%, correct? In equity market, what is the post-tax returns? In last 14.5 years, we have delivered 19% compounding. We have seen all types of governments, all right? From 2009 to 2014, it was a Manmohan Singh government, UPA 2. And then, NDA was government. And so we have seen all cycles, and still we delivered 19% compounding. So what I'm trying to say is that there are enough opportunities, in India for corporates. There are enough opportunities to select from such companies which can keep growing 18-20%. Rupees 10,000 invested in 1990 or 2001 or 2020 or 2022. At every point, if you would have invested, you still made big money. So I think equity as an asset class which will keep delivering you long-term returns. This is a long-term game, am I right? This is not a short-term 1 month, 3 months, 6 months. And I have no doubts in my mind that Indian equity market will keep delivering exceptionally strong returns for any investor who have a long-term horizon. Please keep faith and please add to this asset class. Every decline, take it as an opportunity.
If I can add here, this is, you talked about INR. If you look at even USD returns, people compare this with US markets and USD returns there. So whether on 5-year, 10-year, and 20-year basis, our returns in US dollar terms are equivalent to what US markets have delivered. And these are in double digits, 10 to 12%. So despite, annualized depreciation of 3 to 4%, yet we have delivered double-digit US dollar returns.
Thanks.
No, just a minute. Let me just show one slide. Just a minute. this is a 20 times returns in 24 years. 1 crore invested in 2001 is now 20.6 crores, including today's correction. You know, which asset class can give you this 20 times in 24 years?
Yeah.
This is all types of government. It is all types of slowdown, Lehman collapse, dollar problem, Russia problem, Ukraine problem, every EU crisis, Middle East crisis, so many elections, central government, state government, US election, Europe election. 20 years we have seen COVID, the biggest of the worst of the crisis, correct? And
Yeah.
yes, there were corrections in between. But keep the faith, then people who have investor who have this kind of a patience, it is made for those investors. Then you get that kind of a reward. So, I have no doubt as an investor, you should not worry and keep faith on equity asset class. At times you have to not look at every month fact sheet, otherwise you will get, sometimes your mind will say, what should I do? At times you have to switch off yourself from the noise, and more and less noise will impact you more and more positive impact for your portfolios. Be out of noise for few weeks. Be out of noise.
Okay, great. Thanks, Raj. Next question, sir. What should be the minimum time horizon in IOP or budding beast? What
IOP,
if?
sorry, IOP is a multi-cap PMS. Generally, minimum horizon should be 3 to 5 years. Budding beast is a mid and small cap PMS. Although our portfolio companies are very big, we do not own any micro cap or micro companies. Still, I recommend that you should have 5 years horizon, considering it is a mid and small.
Yeah, the next question of the same person is, what if I have some extra funds for a lesser horizon period, like 2 to 3 years?
Minimum 3 years, then IOP is okay. But less than 3 years, please do not invest in equity asset class. Not only my fund, don't invest into any product. Equity market is 3 to 3 years minimum should be horizon for multi-cap.
Yeah.
Please remember, it is your hard-earned money. We are trustee of your money. We'll do our best to keep delivering superior returns, but it is your hard-earned money, and you should make sure protect capital, create wealth. Never be greedy. If you make returns in 3 years, you can always redeem, no problem. But don't invest with a 2 years horizon.
That ends the question queue. All the questions are already answered. Thanks, Rajesh. Thanks, Govind sir. Thanks everybody for finding out your time. Yes, as AAA is known for its risk management and consistency, we will definitely sail through all sort of uncertainty and volatility. Our portfolios are poised to do better in such thing, even better, in fact, rather. Happy investing. Thanks. Thank you.
Thank you. Thank you all.
Thank you, friends. Thank you very much for your valuable time. Looking forward to interact with you. And if you have any queries, you can put it to Sandeep or Sucheta based in Bangalore. Thank you. Thank you, everyone. Bye-bye.